is trading very much, the characteristics of it are exactly the same as a US tech stock. The difference being, whereas S&P, NASDAQ have all been cheap on our models, beaten up in the last couple of weeks, crypto has looked expensive. So in a way, we've been kind of waiting for this price action.
The hot topic is the latest CPI report and the possibility of the Fed increasing interest rates again. Jim Bianco, who is the president of Bianco Research, an economic data insights provider, would in today's episode give us insights on the impacts we can expect from further rate hikes and the position of Bitcoin in all this. Welcome to Wealth Supremacy, the channel that puts together all the news you need about the economy and assets market. Subscribe and turn on the notification bell so you never miss out. Now let's get down to business with Jim Bianco.
The banks are making billions of dollars a day. How do we know that? Because the Fed in the last couple of weeks, as rates have gotten over 3.5, they're starting to lose money at the Fed at a rate of about $2 billion a day. Now, what does that mean that they're losing money at the Fed? Well, that's what they're paying the banking system is $2 billion a day. So the banks are making a tremendous amount of money off the Fed. Now, if they raise their deposit rates, to 3 and they're getting 3.15 from the Fed, there's a positive spread there, but it goes away. But back to that, right. The Fed losing money. Joseph Wang, the Fed guy, really did a blog post on this last week, explained it very well. They'll just create this thing called a deferred asset and give it to the Treasury. Hey, Treasury, we owe you $1 gazillion. And someday in the future, when we've got $1 gazillion, we'll pay you that $1 gazillion. And the Treasury's like, well, the Fed's the safest credit in the world, and they'll play that game. So it doesn't mean the Fed's going to have to take a loss or sell securities or print money, but it's all part of the opaque accounting and a shell game that they've been playing because of QE. But the fact of the matter is it does expose how much money the banks make off the Fed by raising interest rates and keeping deposit rates at zero. Even if money's leaving, you still got trillions of dollars. They're making 3%. That's a lot of money for the banking system when you add it to their bottom line.
The one sector that is benefiting from the current economic situation is the banking sector. As interests continue to rise, they continue to make more money. Banks are targeting customer deposits as they keep interest on deposits low, which is a deviation away from the interest hikes which should reflect across the financial sector. They are simply taking advantage of the situation to make as much money as they can at the detriment of their customers, while on the other hand, they're giving out loans at an increased interest rate. The interest on savings account is an average of 0.13%, even though annual percentage rate APR for credit cards is now at 21.59%, which is a huge 2% leap from its January position. According to Jim, the banks are sharing a daily profit of about $2 billion received from the interest they're gaining from the current high rates. This reflects the net interest income, NII, banks are reporting. These net income interests are accrued from the difference the bank gets between the interest they pay to customers for their deposits and what they earn from loans they give out. JP Morgan reported an NII of $17.6 billion in Q3. This is a 34% increase from last year. Other banks such as Wells Fargo and Citi are also up, reporting interest incomes that are at a 3-year high.
If you told me that by October that the global aggregate index was going to be down 21%, I would have told you don't understand how the bond market works. It doesn't do that. Well, it just did. And then the other one is the MOVE index. That is the Merrill Option Volatility Estimate. It was developed by Harley Bassman when he was at Merrill Lynch. Now he's at Simplify Asset. And it's basically the VIX of the bond market. It is at one of the highest readings we've ever seen. There was only one plot point on March 9th, 2020 that has been higher than anything we've seen in that index back to the global financial crisis in 2009. What this suggests is what Diamond was talking about, is that the bond market is too big, too opaque, and too complicated for even Jamie Dimon to tell you over there, those British pensions with liability-driven investing are going to blow up next week. Nobody knows. It's too big, it's too opaque, and it's too complicated. But when you look at the losses that the bond market has, you look at the volatility that the bond market has, and even I could turn to you then and say, this is the environment, I'm going to use some technical languages here, where shit goes sideways. And some shit has been going sideways, and I expect more shit to go sideways as well. And that's really all you can do. And so, yes, I do think I would tell you that if we're done blowing stuff up right now and the market stays at these points, that would be the surprise. What's going to blow up next? Like I said, Diamond doesn't know what's going to blow up next. I don't know. Nobody knows. It's too big, too opaque, and too complicated. But when you look at those losses and that volatility, you know that there's a world of hurt out there in the fixed income market. And it's, only a matter of time before we see another body float to the surface.
At the end of Q3 this year, global bonds outflow was at $175.5 billion, the highest in the past 20 years. This is in reaction to the increased interest rates by central banks around the world, sparking fear of a recession. This has made the net value of global bond funds go down by 10.2%, the biggest decline since 1990. U.S. high-yield bonds had a sell-off amounting to $65.81 billion, while emerging markets accounted for $80 billion of the global outflow. How did this happen? Corporations and governments had taken advantage of low rate to borrow heavily, but they are now burdened by the high rates imposed, which is a recoup strategy of the central banks. It is predicted that this outflow is likely to continue deep into 2023. Jim says no expert can predict what would fail next as it is now, but one thing is sure, more buzz should be expected across the market.
Maybe something will happen in crypto. Then we could have something, because right now volumes are down, market's grinding sideways, and a lot of people are getting very antsy in crypto. But that's kind of the way that, bear markets end. They end not with a bang, but with a whimper. And the crypto market's starting to whimper. The TradFi markets are not. So, I think they might be closer to a low. I'm not saying that their low is nearby, but in general, I think they might be closer to a low than the TradFi market. If you measure it as a realized volatility measure, this is one of the rare periods where the S&P has higher volatility than Bitcoin. It's only happened 4 times in the last 10 years for a couple of days. And it started on Wednesday of this week again for the first time since 2020.
In a twist of events, after a very disastrous Q1 and Q2, cryptocurrencies have come back in the third quarter to be the best performing assets, only behind the US dollar. Bitcoin has particularly been able to hold its ground within the bounds of $19,000 and $20,000. This level of stability has not been seen in cryptocurrency in a long time, and it is not often seen in this highly volatile market. Bitcoin price has stayed about the same for almost 2 months now, while the Nasdaq has fallen 13% and the S&P dipped 10%. Could this be the end of the dip for Bitcoin, or could this be the quiet that precedes a storm? Leave a comment and like this video to keep the views coming. Thanks for watching. Don't miss the next video.